So glad to see everyone for another Tax Tuesday. That's what we call it. And my name's Luke Robinson, and I'm a new business advisor here with Collective. And Collective is essentially your all in one service for your small business. We'll handle the whole shebang, specifically when it comes to an S Corp. So we would set up the business, handle payroll for you, handle bookkeeping, and tax filings at the end of the year. But today we are running a fun little session we like to call Tax Tuesday. And every Tuesday, we essentially host an AMA. It's an Ask Me Anything surrounding, best business practices, best financial business practices, best tax and accounting practices, and just kind of any sort of question that can come to your mind that you've always been curious about, about running your business or how it relates to the taxes and whatnot. But also keep in mind, just to get the legal stuff out of the way, consider this just information. Don't consider this, official legal advice or tax advice or anything like that. The tax code is very complicated, and some of the stuff I could be saying could be incorrect. You never know. So always be sure to consult with, a CPA or some sort of tax professional before you act on any of this information. But now that we've got that out of the way, we can go ahead and start with some questions. And the first one is, what is an S Corp? Well, that's an appropriate question, of course. And really, a lot of people, when they think of S Corp, of course, they think of S Corporation, meaning they think that, okay, well, this must be a corporation. Like if you hear the word S Corp, or someone says that they're an S Corp, that automatically means they're a corporation. But that's not the case. And an S Corp isn't a business entity. Like it's not a corporation, it's not an LLC. What it is a tax election. So it's a way to ask the federal government to tax your business in a certain way. And you have to be either, an LLC or corporation, or some sort of business entity like that before you can even elect the S Corp tax status. So that's the first thing that I would say. And then the entire reason you'd want to do that, essentially, is to save on the self-employment tax. Self-employment tax, it's a flat tax rate of 15.3%. So before you become an S Corp, like if you're just an LLC or a sole proprietorship or, a partnership, usually all of your net income from the business is subject to the self-employment tax, or a big chunk of your net income is. So, for example, let's say that you made $100,000. That was your net income. If you're just a sole proprietorship or an LLC, how you'd come up with your self-employment tax is you take $100,000 and you'd multiply it by 15.3%. All of your money is subject to it. But what happens with an S Corp election is technically you become a W-2 employee of your own business, essentially. And now you're still the owner, of course, it's still your business, but for tax purposes, you literally become employed by it. You literally become an employee of your own LLC. And since you're an employee, your business will pay you a salary. It'll pay you a wage just like you'd receive, if you work for someone else as a W-2 employee. But the cool thing about S Corps is that the only chunk of your earnings that's subject to the self-employment tax is your salary amount. So, for example, like going back to my earlier example, if someone's making $100,000 in total, but they're paying themselves, let's say $40,000 in W-2 salary, then only that $40,000 is subject to the self-employment tax. The other $60,000, or just the rest of your money, outside of your salary, those are considered distributions to yourself. Like conceptually speaking, you can kind of think of that money as dividends almost. You can use that term. But long story short, that chunk of money is no longer subject to the self-employment tax at all. So in that scenario, an S corp would save someone. Let's see what that is. It would save them $9,180 in the self-employment tax. So it makes a lot of sense to go the S corp route. Once you reach a certain income level, and once it becomes right for you. Can I write off books? Well, it depends on what those books pertain to. Like if they're educational books that are helping you learn more about, your industry or your skill set or your business, and it's ordinary and necessary for your business, then sure, you could write off books. But it just has to do with the business. You can't, if you're reading these books for pleasure, you're reading fiction or anything like that, then they typically wouldn't be something that you could write off in the business. What happens if you never turn your side hustle into an LLC? Well, I mean, really, what the LLC does is it provides separation, between your personal assets and your personal financial life from your business assets and your business financial life. So really, that's the main thing that it does. And if you never turn it into an LLC, the tax implications won't change much. None of that will change much. It's just you'll have less protection because you don't have that legal entity. So that's really the only difference. Oh, Sean had a great question. How much does a CPA usually charge to do a late S corp election for a client, and how much does Collective charge? Well, a CPA can usually charge a pretty penny for something like that. I mean, for a late S corp election and to do some alterations to the bookkeeping, clean up the books, adjust payroll, you're probably looking at least $1,500 to $2,000, something like that. And Collective, believe it or not, when you come on board, there's a one-time $199 onboarding fee and $199. And that covers backdating the S corp election, cleaning up your bookkeeping, and getting you set up. So it's a big difference. If Collective works for you, then it can be a pretty financially efficient way to handle your S corp. I have business meetings at my house. Since I use my house as my office, can I write off hiring a cleaning service before my meetings? You can only write off the portion of the cleaning service that has to do with the area of your business use of your home. So, for example, let's say that you spend $200 a month on your cleaning service. And let's also say that the square footage of your let's say the total square footage of your house is 3,000 square feet, and the square footage of your business use of your home, let's say that that's 1,000 square foot. Essentially, what you would do is you'd come up with a percentage rate. You'd take 1,000 and you'd divide it by 3,000, and you get around 33%. And you'd multiply 33% by your $200 cleaning fee. So, because you can write off 33% of that expense. 33% of it is attributed to business. So if it was $200, you could write off $66 in a cleaning fee. Can a partnership become an S corp? Yes, it can. And a partnership, I mean, really, all that is a LLC with two or more members on it. That's essentially what a partnership is. But they can make an S corp election, sure. All right. Johnny has a good question. At what income level is an S corp beneficial to me? Well, that is that is kind of a hard question because it depends. It depends on what state you live in, largely. It depends on what state you live in, kind of what industry you're in. But generally, what Collective says is we give a general net income of around $60,000 net income. If you expect to make at least $60,000 in a 12-month time period, that's when an S corp becomes worth it, and that's when we say Collective becomes worth it. Now, for other, well, also like I just said, it depends on the state. And the reason I say that is because there's certain states when you make an S corp election on your business, you pay additional taxes. For example, in certain areas of New York, there is something called a general corporation tax that you pay with an S corp. And in Tennessee, I believe you pay excise taxes when you have an S corp. So so in those states, and again, this is very general, it's not exact, but in those states, we bump up the income suggestion to around $80,000. So I would say just, kind of just generally between $60 and $80,000 is a good kind of rule of thumb to at least consider an S corp. Ooh, here's another great question. I'm a content creator and use AI tools to make my content. Can I write off those subscriptions? Well, usually, let's say that they're just personal subscriptions and you use it on a personal basis a lot and you're just kind of every once in a while using it for your business. Usually you can't write that off. Like the IRS has something called like an exclusivity test, and really to write things off for things like this, you're supposed to explicitly use it for your business. So keep that in mind. Now, let's say that you dedicate like this AI system completely to the business. You don't use it for anything else. Then it could it could be possible that you could write off those subscriptions. Sure. Oh, in California. Okay, so Johnny's asking what sort of basic income level in California is it worth it to go forward with the S corp? Collective says around $60,000. If you're in California, a good rule of thumb is a net income of $60,000. Meaning after you pay your expenses, you have all your deductions and everything like that, then you come up with your net income. Ooh, another good question. There's a good question left and right today. The question is, if I have too much money in my business account, can I take out a significant amount and use it towards stocks, real estate, etc., personal investments? If so, what are the tax complications, if any? So there's not really tax complications. Like if you set up an LLC and you've got a separate business bank account and money is just sitting in the account, you can just transfer it to yourself personally, whenever you want to. And you could use it towards anything you want. You can use it towards stocks, real estate, bonds, just other investments. And there's not really tax complications on the business side of things. Now you have to start, like when you buy these things, you have to start, reporting your dividends that you get from stocks, your interest, your real estate income, things like that. There's tax implications for that, but not really for your business. And what I mean is that, especially when you're just an LLC, you're simply just taxed on money that's left over after you spend business expenses. Any money you make, from January 1st to December 31st, and any money you spend between that same time period, whatever you're left over is you're taxed on. That's it. And then you can use it for whatever you want. You can use it to buy investments or do whatever you want. But keep in mind that there's not really the only way to kind of save money that's kind of sitting in your business bank account and kind of saving unused money and kind of sheltering it from taxes are self-employed retirement accounts, tax advantaged retirement accounts. And those are really the only thing that lets you take a chunk of money and, kind of prevent from paying income tax on it, essentially, at this point anyway. Okay. What's the difference between a C corp and an S corp? Well, again, the difference between and again, it's confusing because the IRS is pretty interesting. When they try to have their own terminology, they use pretty interesting terminology to refer to things. Um, so keep that in mind. So don't feel too bad if you get confused because this stuff is very confusing. But the difference between a C corp and an S corp is an S corp. The technical name for it is an S corp tax election. So it's not a business entity like a C corp is. A C corp is a business structure. It's something that you set up usually with your state of residence. That's a corporation. Now, a C corp can make an S corp election and become an S corp, or be taxed under the S corp tax rules. So you can do that, but you can also do that with an LLC. An LLC, can make an S corp election. But the main difference is a C corp is a business entity and an S corp is a tax election. Okay. In what situations would you want a C corp as opposed to an S corp? Well, really, I would say, and that's a complicated question. There are a lot of implications between the two, but I would say, let's say that if you plan on fundraising for your business, having more than 100 stock or, shareholders or 100 owners in your business, then usually you'd want to go with the C corp route. Because with an S corp, you can only have up to 100 shareholders. There's a limit to how many people can own your business. So, if you plan on, offering a piece of ownership to thousands of people, then as opposed to just a few, then you need to go the C corp route as opposed to the S corp. How do you go about calculating quarterly tax? Well, quarterly taxes, the technical name for them and how they're usually referred to are quarterly tax estimates. And what that means is, and where the challenging part comes in, is that you have to estimate these taxes. You literally have to estimate your income and how much you think you're going to make. So, kind of the general process is you kind of estimate, how much money you're going to make the entire year. Let's say that's, $100,000. And then you also have to estimate your total expenses, your business expenses for the year too. And let's say that's $30,000. So then your net income is $70,000. That's your estimated net income. And then the easiest way to do it is just to go online, find a trusted and reliable tax calculator, from a reputable company, and use it to calculate your tax. Calculate your tax for the total year, and then just divide that by 4 and pay that amount each month or each quarter to the government. And you can do it on the IRS website. You can do it right online to where it's pretty convenient. Um, so yeah, Paying estimated taxes is pretty straightforward when you do it that way. Okay. Can you still have a self-employed retirement account with an S corp? Yes, you can. Absolutely. And when you're self-employed in general, you can really take advantage of the tax code when it comes to retirement. And I mean, there's situations to where I've seen business owners, save up to $60,000 annually in tax-free current tax-free retirement account money. How do you form a partnership? Well, there's a few steps. And one, like I mentioned earlier, a partnership is essentially just, like I said, two or more people on an LLC. That's when two or more people have an ownership interest in an LLC. And what you do is you go to your Secretary of State website. That's usually where you form an LLC with your state, and you go and you start forming the LLC. And you can do that online. And what you'll do is you'll list multiple members on it. You'll list the information of the members. The members will sign, and then you'll have a multi-member LLC, which is a partnership. And essentially, from there, you also will need a partnership agreement. And with the LLC, when you're just a single member LLC by yourself, the corresponding document to that is called an operating agreement. But with a partnership, it's called a partnership agreement. And what it is, it's just a legal document that kind of outlines who owns what, the agreement and how things will be structured between partners. So that's really important for your business to have a partnership agreement. But then also keep in mind that when you form a partnership, you now have a partnership return requirement with the Internal Revenue Service. So it's called a Form 1065. It's a partnership return, and it's an annual requirement each year with the IRS. And if you don't make it, it could be late, and they could charge you penalties and whatnot. So it's something you definitely want to avoid. How can I amend a partnership agreement? Well, I think it depends on your state, but usually things like a partnership agreement, and again, it's usually a good idea to speak to a business attorney or a business lawyer before doing anything like this. But usually partnership agreements, in my experience, and the same with operating agreements, like on LLCs and whatnot, you can amend it on your own. Like you can amend just the document on your own, and kind of record when it was done, have all members sign agreeing to the amendment, and then you can kind of keep that for your own records. But let's say that if you ever wanted to amend your articles of organization, and your articles of organization it's paperwork you file with the state to form your LLC or form your partnership. And let's say that you want to remove a member, you want to add a member to it, you want to do things like that, then you have to file an amendment with the state directly to change your articles of organization. But again, those sorts of things, especially with partnerships arrangements that have a lot of money flowing through them and whatnot, it's a good idea to have an attorney to help you navigate through it and make sure that everything's structured correctly. How does all this work with a corporation? Well, like for example, when you have an LLC, the legal document behind your business is called an operating agreement. When and articles of organization. But then with your state of residence, if you're forming a corporation, you file articles of corporation. That's what they're called. Um, and then a corporation, it's just different. It's a completely separate entity. It has a separate name, its own EIN number. And then an LLC, though, it's it's kind of a more simplified version of a corporation, is what an LLC is. It provides the same sort of legal protection and asset separation, but it doesn't have the same sort of complexities and administration that a corporation does, and it has less paperwork to deal with. How do my personal taxes change when I'm an S corp? That's a great question. So, kind of paradoxically, your personal tax situation becomes a little bit more simple when you make an S corp election. It's easier to file your personal return. So, before you become an S corp, like if you're just an LLC, a sole proprietorship, or something like that, then all of your business information, your write-offs, your expense categorizations, like your income, all of that information goes on your personal tax return. It's recorded on your Schedule C of your personal return. So it's more complicated to file. Like it's more complicated to compile the information and organize it and get it on the personal return. But when you become an S corp, all of that information goes over to the S corp tax return. That's your business return now. And then for your personal return, you kind of go back to like an LLC, to a W-2 employee sort of situation to where you just fill out a form. And it's usually a lot easier. But unfortunately, that's all the time I have today. I actually have to go and prepare for a meeting with a prospective collective member. But I had a lot of fun, and I hope that you guys found it useful. And we do this every week. So please, if you would like to learn more about S corps or how to run your business, we'll see you next week for another Tax Tuesday.